Imagine a 67-year-old retiree. Let's call him David. David goes to his local bank branch, makes a standard routine withdrawal from his retirement account, and goes home thinking everything is fine. A few months later, the IRS sends him a notice. They are legally seizing 25% of the money he left behind. And because of that single withdrawal, his Medicare Part B premiums are suddenly going up by hundreds of dollars a year. David didn't try to cheat the system. He didn't make a reckless investment. He just missed one specific, quiet deadline created by a new set of IRS rules that explicitly target anyone born before 1962. Right now, there are 4 hard-coded IRS deadlines approaching between today and January 2027. If you were born before 1962, you are standing directly in the crosshairs of all 4. Miss them, and you could easily hand the federal government an extra $14,000 in penalties, stealth taxes, and Medicare surcharges. And I want to be absolutely clear, nobody from the IRS is going to call and remind you to file the paperwork. For over 15 years, I have sat at kitchen tables helping seniors untangle the mess Congress made of their retirement. Today, I am going to give you the exact dates, the exact forms, and the exact traps hidden in these new tax laws, so you do not lose a dime of your own savings. Why is the government suddenly targeting this specific age group? It is not an accident. If you were born before 1962, you are caught right in the middle of a massive legislative tug-of-war. In the last few years, Congress passed 2 different laws that completely rewrote how your retirement is taxed. First, they passed the Secure Act 2.0, which changed the exact mathematical age you are forced to pull money out of your accounts. Then, they set a ticking time bomb on the tax code, meaning your basic standard deduction is scheduled to be physically chopped in half by 2026. The system is now a minefield of overlapping dates. The rules you retired under are no longer the rules you are living under today. And here is the brutal truth. The IRS system is built to penalize this confusion. They know that ordinary retirees, people who live on a fixed income and do not have high-priced tax attorneys on retainer, are going to miss these dates. When you add up the penalties for missing your required withdrawals, the stealth taxes on your Social Security, and the sudden jump in your Medicare premiums, the average middle-class retiree is looking at a $14,000 hit. That is not a rounding error. That is a roof repair. That is months of groceries. That is your money, quietly repossessed by the system simply because you did not know which calendar day to circle. It is not your fault this is confusing, but it is absolutely your problem to fix. So grab a pen and a piece of paper. We are going to go through these 4 deadlines one by one. And the first one triggers a massive federal penalty that can wipe out a quarter of your savings overnight. Let's start with the deadline that feels the most like outright theft. Deadline number 1 is the required minimum distribution cliff, commonly known as your RMD. For decades, the government allowed your retirement accounts to grow tax-deferred, but they never intended to let you keep all of it. Eventually, they want their cut. The law forces you to start pulling money out of your traditional IRAs and 401k cess so the IRS can finally tax it. Here is where the trap snaps shut. The recent Secure Act 2.0 changed the starting age. If you fall into this specific demographic, your magic number is now age 73. But the IRS does not just politely ask you to take the money out sometime during your 73rd year. They enforce a merciless, hard-coded deadline, April 1st of the year after you turn 73. If you miss that exact April 1st deadline by even a single day, the IRS hits you with an excise tax of 25% on the money you were supposed to withdraw. Let me put real numbers on that so you feel the impact. Let's say your required withdrawal for the year is $20,000. You get confused by the new age brackets, or your accountant fails to flag it, and you miss April 1st. The IRS legally confiscates $5,000 of your savings. It is just gone. No warning, no late notice in the mail, a 25% penalty straight out of your pocket, just because you missed a date on the calendar. And yes, the new rules say if you catch the mistake quickly enough, you might be able to get that penalty reduced to 10%. But why should you hand over a single dollar of your life savings for an honest administrative mistake? You must instruct your financial institution to automate this withdrawal well before that April cliff. Do not try to time it yourself at the last minute. But here is the part that most seniors never see coming. Paying a massive penalty to the IRS is bad enough. But fumbling this withdrawal quietly triggers a second, completely invisible trap. And this one does not just hit your taxes, it targets your health care. Here is the truth about how the federal government operates behind closed doors. The IRS does not keep your financial secrets to itself. It talks directly to the Social Security Administration, and they use that pipeline to quietly drain your monthly check. It is called IRMA, the Income-Related Monthly Adjustment Amount. But I call it the 2-year ghost tax because it haunts you long after you think your tax bill is settled. When you take that required withdrawal we just talked about, or when you sell a piece of property, or even if you just move some money around to help a grandchild, your income on paper suddenly goes up. The IRS sees that spike on your return, and they immediately pass that exact data over to Medicare. Because of a hidden rule called the 2-year look-back, the income you report on your tax return this year directly controls what you will be charged for Medicare Part B and Part D 2 years from now. Think about how incredibly unfair that is. Let's say you have a one-time spike in income today because you sold some stock to pay for a medical emergency or a home repair. 2 years down the road, when your income has dropped back to normal, your Medicare premiums will suddenly skyrocket. Hundreds of extra dollars will be silently deducted from your Social Security check before the money ever reaches your local bank account. You open your mail, look at your monthly deposit, and wonder why your Social Security check actually went down when inflation is going up. This is exactly why. The system engineered a way to penalize you twice for the exact same dollar. First, the IRS taxes the withdrawal. Then, Medicare uses that same withdrawal to make your health care much more expensive. Most seniors feel totally helpless when this happens. They just accept the smaller check and try to figure out how to stretch their grocery budget. But you do not have to just sit there and take it. There is a specific legal backdoor built into the system to stop this surcharge dead in its tracks. But you have to hit a very precise calendar deadline to use it. Deadline number 2 is the December 31st income look-back cliff. Because the government operates on that strict 2-year delay we just talked about, the exact financial moves you make by December 31st of this year will completely dictate what Medicare charges you in 2027. At the stroke of midnight on New Year's Eve, your income for the year is locked in stone. The IRS takes that final number, hands it directly to Social Security, and if it crosses their invisible threshold by even one single dollar, you get slapped with the IRMA surcharge, just $1 over the line, and you pay the penalty. But here is the inside knowledge that puts the power back in your hands. You do not have to just accept that surcharge if your financial reality has legitimately changed. If you recently retired and stopped working, if you lost a spouse, if your pension was reduced, or if you had an involuntary loss of income, you have a legal right to fight back. There is a specific document you need to know about. It is called Form SSA 44, also known as the Life-Changing Event Form. When you file this form, you are essentially telling the federal government, my income from 2 years ago is completely irrelevant today. Do not base my Medicare premiums on money I am no longer making. If you file Form SSA 44 and show you experienced one of their approved life-changing events, they are legally required to recalculate your Medicare premiums based on your current income, not the ghost income from the past. I have watched this one single piece of paper save retirees thousands of dollars a year. It takes the invisible target off your back and puts that money straight back into your Social Security check where it belongs. Watch your income limits closely as December 31st approaches. And if you are already getting hit with these unfair surcharges because of a past event, pull up Form SSA 44 this afternoon. Getting out of the IRMA trap is a massive relief, but do not look away yet, because there is a much bigger expiration date hurtling toward us. It hits the entire tax code, and it happens at the exact stroke of midnight in 2025. Let me ask you a question. How would you feel if you lived on the exact same income next year, down to the penny, but your federal tax bill suddenly shot up by thousands of dollars? That is not a hypothetical scenario. That is current federal law. On January 1, 2026, the Tax Cuts and Jobs Act, the law that gave us historically low tax rates over the last few years, is scheduled to completely expire. This is the midnight tax increase of 2026. Here is exactly what happens when that clock strikes midnight. First, the actual tax brackets physically shrink. The 12% bracket is scheduled to snap back to 15%. The 22% bracket jumps to 25%. That means the percentage the IRS pulls out of your IRA withdrawals, your pension, and your investments automatically goes up. Second, and this is the trap that hurts everyday seniors the most, the standard deduction is scheduled to be chopped roughly in half. Think about what that actually means for your money. Most retirees do not itemize their taxes anymore. They rely on that massive standard deduction to shield a huge chunk of their income from the IRS. When that deduction drops, thousands of dollars of your money that used to be completely tax-free will suddenly be exposed to those new, higher tax brackets. You can leave your money exactly where it is, make the exact same withdrawals just to pay your utility bills and buy groceries, and you will still owe the IRS a much bigger check at the end of the year. And what bothers me the most about this? Nobody on the evening news is explaining this in plain English to older Americans. They argue about how this affects giant corporations. But the people it truly punishes are honest retirees living on a fixed income. Knowing this massive tax hike is coming down the tracks is simply not enough. You have to know how to step out of the way. And that brings us to the specific deadline you must hit to shield your money before the gate permanently drops. Deadline number 3 is the pre-2026 Roth conversion window. And this is exactly how you beat the IRS at their own game. Right now, if you have money sitting in a traditional IRA or a standard 401k, the IRS essentially holds a mortgage on your savings. They have the power to decide exactly how much of it they are going to take when you finally pull it out. And as we just covered, on January 1, 2026, they are officially raising their rates. But until that calendar flips, you have a rare opportunity to pay taxes on your savings at today's historically low rates. You just have to make the move before December 31st, 2025. This is where a strategy called a Roth conversion comes in. When you execute a Roth conversion, you deliberately take money out of your taxable retirement account, pay the lower tax rate on it today, and move that money into a Roth IRA. Why would you volunteer to pay taxes right now? Because once that money is sitting safely inside a Roth IRA, it becomes legally invisible to the IRS. It grows entirely tax-free. And when you withdraw it 5, 10, or 20 years from now to pay for medical bills, property taxes, or just to live your life, the IRS cannot touch a single penny of it. It does not matter if Congress doubles tax rates in the future. That money is permanently shielded. But the window to lock in this discount is closing fast. If you wait until January 2026 to start shifting your money, the tax cuts will have already vanished. You will pay thousands of dollars more to move the exact same amount of wealth. You need to sit down with a tax professional this year and ask, how much of my savings should I convert to a Roth before the 2025 deadline? By doing this, you are using the government's own timeline to protect your money. That strategy protects your retirement accounts, but there is one final deadline you need to know about, and it targets the most vulnerable seniors of all, widows. Let me tell you about the single most cruel trap in the entire tax code. It is called the widow's penalty, and it targets seniors at the exact moment they are the most vulnerable, the most overwhelmed, and the most grieving. When you lose a spouse, the emotional toll is devastating. The absolute last thing you are thinking about is your tax filing status. But while you are trying to figure out how to navigate life alone, the IRS is quietly recalculating exactly how much extra they can take from you. Here is how this brutal rule works. For the calendar year your spouse passes away, the IRS still allows you to file as married filing jointly. You still get the large standard deduction, and your money is still stretched across those wide, generous tax brackets. But on January 1st of the very next year, the trap slams shut. Overnight, the IRS abruptly drops you into the single filer category. That means your standard deduction is instantly slashed in half. And those wide tax brackets? They suddenly compress. Think about the actual financial reality of a surviving spouse. Yes, one Social Security check goes away. You only get to keep the larger of the two. But your other income, like required IRA withdrawals, pensions, and dividends, usually stays exactly the same. And your basic living expenses, heating the house, paying property taxes, maintaining the roof, do not magically drop by half just because you are suddenly living alone. So you have roughly the same amount of taxable income, but because you are now forced into the single tax bracket, that money is taxed at a dramatically higher rate. Nobody from the government sends condolences. They just send a higher tax bill. It is an absolute gut punch. I have seen widows sitting at my desk, holding a tax notice they cannot afford, completely blindsided. They did nothing wrong. The IRS simply used their grief as a trigger to raise their taxes. It is heartbreaking. But there is a specific, legal way to maneuver around this penalty to protect the surviving spouse. You just have to know exactly what to do before that calendar year closes. Deadline number 4 is the year of death asset shift, and this is the exact legal move you use to soften the blow of that widow's penalty. I know that in the months after losing a husband or a wife, the very last thing anyone wants to look at is a tax spreadsheet. But that hesitation is exactly what the system is counting on. You have a mercilessly short window to protect the surviving spouse, and that window closes forever on December 31st of the year the spouse passes away. Because you are still legally allowed to file a joint tax return for that final year, you still have access to those wide tax brackets and that massive standard deduction. This is your very last chance to use them. The strategy here is to deliberately accelerate your income before the year ends. If you know you are going to need to sell a piece of property, cash out some stock, or take a large withdrawal from your IRA to pay for living expenses over the next few years, do not wait until next year. Do it right now, before December 31st. If you pull that money out during the year of death, it gets taxed at the much lower, married rate. If you wait until January to make that exact same withdrawal, it gets taxed at the brutal single filer rate. This is also the absolute best time to execute a Roth conversion. Move as much money as you can afford into a tax-free Roth account while you still have the benefit of those joint tax brackets. You are essentially prepaying the taxes at a deep discount, so the surviving spouse never has to worry about the IRS touching that money again. If you are an adult child helping a parent through a sudden loss, this is where you step up. You protect their money when they are simply too overwhelmed to do it themselves. We have just covered 4 massive deadlines that most seniors never see coming. Now, let's bring all of this together into one single cohesive defense plan. Here is the exact checklist you need to execute this week. If you ignore everything we just talked about, the math is brutal. Add up a 25% penalty on a missed RMD. Add in a year of inflated Medicare IRMA surcharges. Throw in the sudden jump in tax rates when the TCJ expires. For a normal middle-class retiree, ignoring these deadlines easily eclipses $14,000 in lost money. But you are not going to ignore it. Here is your exact checklist for this week. First, call the institution that holds your retirement accounts. Tell them to fully automate your required minimum distribution so there is a 0% chance you miss that April 1st cliff. Second, pull up your most recent Medicare Part B premium notice. If your premiums jumped because of a one-time income spike, search online for Form SSA 44. Print it, fill it out, and mail it in to drop that surcharge. Third, call your CPA or tax preparer and ask one specific question. Should we be doing a Roth conversion this year before the 2026 tax brackets shrink? And finally, if you or someone you love recently lost a spouse, sit down with a professional immediately to utilize those joint tax brackets before December 31st. You do these 4 things, and you lock the IRS out of your savings. Here is the bottom line. The IRS is never going to knock on your front door to tell you a deadline is coming. They are not going to call to remind you that your tax bracket is shrinking, or that your Medicare premium is based on ghost income from 2 years ago. The system is built to sit quietly and collect the penalty when you miss the date. The only person who is going to protect your retirement savings is you. Now, one quick legal note because it matters. This video is general education, not personal legal, financial, or tax advice for your specific situation. These rules are incredibly complex, and your exact numbers matter. Always confirm your strategy with your own CPA, financial advisor, or estate attorney before you make a move. But do not let the need to check with a professional become an excuse to do nothing. Doing nothing is exactly what triggers every single one of these penalties. If this video opened your eyes, do one thing for me. Send it to one person you know who was born before 1962. They are standing in the exact same crosshairs, and there is a very good chance nobody has told them these deadlines exist either. That one share could save them thousands of dollars. Hit the subscribe button and turn on the bell so the next rule change doesn't catch you off guard. Thank you for watching,